Welcome to The Explainer. Today we're diving into Rites Limited, a huge name in infrastructure consulting. And well, as the title suggests, this is really a tale of two completely different stories. Let's start with the first one. Okay, let's kick things off with this number, 45.19 crore rupees. It's a big, impressive number, right? The kind that just screams success and momentum. But what is it actually for? So this is for a brand new contract that Rites just landed. We're talking a 4-year deal to provide project management for a major new bridge in West Bengal. This is exactly the kind of headline that gets investors to sit up and take notice. So you see a win like this and you think, wow, this company must be on fire, right? Building bridges, making money, it all sounds great on the surface. And yeah, this is Regis's bread and butter. A big, long-term government deal. It solidifies their spot in the market, makes their order book look fantastic. So that's story number one, the good news story. But, and this is a big but, while they're stacking up these new contracts, if you pop the hood and look at the engine, I'm talking about their latest financial results, a completely different picture emerges. And this is where things get a little messy. Okay, look at this. This is where you really see the disconnect. Net profit up almost 35% year over year. Huge! But the revenue, the actual cash coming in the door, it barely budged, up just over 1%. So how on earth are your profits skyrocketing when you're not really selling more? And this quote from a market analysis just nails it. The profit surge is masking underlying growth concerns. That big profit number looks amazing on a headline, sure, but it's hiding a really fundamental problem. Turns out that profit jump came from cutting costs and improving margins, not from actual growth. So you have to ask yourself, right? Was this just a weird quarter, a one-off thing? Or is this a sign of something bigger and, frankly, more concerning for the company? Well, if we zoom out and look at the last 5 years, the picture gets even more worrying. And remember, this is all happening during a massive infrastructure boom in the country. This is when a company like Rites should be absolutely crushing it. Yeah, this table, it's pretty stark. We're looking at the 5-year compound annual growth rate. And look at those numbers. They're negative. Net sales are down. Operating profit is down even more. You just can't cost cut your way to prosperity forever. At some point, you have to actually sell more. Okay, so we've got these shiny, positive headlines on one side and this really poor long-term growth on the other. You'd think the experts would be cautious, right? Well, not so fast. This is where it gets really confusing if you're trying to figure out what to do as an investor. So check this out. On one side, you've got the human analysts at brokerages. They're looking at this and they're saying buy. They see the potential and they're setting high price targets. But then on the other side, you have the cold, hard data, the quantitative analysis, and the machine says sell. It calls the valuation very expensive and the technicals mildly bearish. It's a total standoff. So, how do we even begin to sort this out? I think the best way to look at it is to split the company into two parts. Its quality, which is its obvious strengths, and its growth, or, its lack of growth. All right, let's start with the good stuff, the quality. And honestly, this company is built like a fortress. They have zero debt on their balance sheet. The government owns over 72%, so it's got that strong backing. It pays out a nice high dividend. Healthy return on equity, it's a market leader. These are all signs of a really high-quality, stable operation. But then you flip the coin over and you've got the growth problem. We've seen the revenues actually shrinking, the stock is priced expensively for a company that isn't growing, and it's been a poor performer in the market. Oh, and that huge dividend payout, almost 95% of its earnings. That kind of tells you the company doesn't have better ideas for how to reinvest that cash to, actually grow the business. And that right there, that brings us to the core dilemma for any investor looking at Rites. So this all boils down to a really important idea in investing called a value trap. Now, Rites isn't necessarily cheap right now, but the principle is the same. You see all these great quality signs, the dividend, the government backing, and you get drawn in. But you might be overlooking the huge red flag, which is the complete lack of growth. And that's how you can get your money stuck in a stock that just goes nowhere. So this is the big question that all of this data leaves us with. You have a financially solid company that simply isn't growing. Is it a safe, stable investment that'll pay you a nice dividend? Or is it a classic value trap where all those good qualities are just hiding a future of stagnation? Figuring out the answer to that is how you learn to look past the headlines and see what's really going on.